Thanks for downloading this episode of the Resilient Advisor Podcast. My name is Jay Coulter, and joining me for this episode is Chris Versace, the Chief Investment Officer at Thematic Research. He is also the Editor-in-Chief of the Thematic Investing Report and Thematic Pro Report. He's the author of the popular Monday Morning Kickoff Letter, which is a must-read for RIAs and money managers. He has been ranked an all-star analyst by Zacks Investment Research. He is the co-host of the Cocktail Investing Podcast and co-author of a book by the same name, Cocktail Investing. Chris, thanks for coming on the podcast.
Jay, thanks for having me. But I got to tell you, after hearing all that stuff, and I appreciate the accolades and the mentions, but I am tired after hearing all those things that I do.
And I had to water that down. Imagine if I went with the full bio.
I know. It's a rough life, but hey, you got to do what you love and love what you do. So
that's right. So, Chris, you are prolific when it comes to podcasting and writing content. I think for this podcast and the listeners, they'd really be interested in honing in on thematic investing. And you had said in our pre-show talk that there are several themes or 10 themes that you have right now that you see in the market that advisors should be looking at. Could you walk through some of those and the implications for advisors as they're allocating for their clients?
Sure. I mean, let me kind of start at the top, if you will, Jay. A lot of investors tend to be sector focused, and we've kind of gone out of our way over the last several years to point out several reasons why sector investing, as we know it, is dead, dated sort of thing. So to begin with, we're different because we look at the actual changing landscapes and intersections of demographics, economics, technology, psychographics, regulatory mandates, and a few other factors, so that we kind of come together with some very pronounced tailwinds. And companies have to change their business models to either ride these tailwinds or risk hitting the headwinds. And the reason why they have to do this is because we're talking about these demographic, psychographic, technological changes that change consumer behaviors or the way that they do things. So like a great example, just to keep it simple, would be, Jay, I'm sure you sit at home on a regular, Wednesday night and you're watching regular TV broadcast television, right? Of course you're not. Of course you're not. That's right. It's like it's like most people, they have shifted over to streaming video, whether it's on an Apple TV, an iPad, their smartphone, or what have you. So that is a pronounced change in the way we consume media. We think about the way that we communicate with people, whether it's messaging, on the Apple iPhone with Messages, or Google with Hangouts, or Facebook with Messenger. Different modalities that have given rise. Or even how we shop. And I am sure, Jay, that you, like I, have more than made your money back on Amazon Prime, and United Parcel Service loves you just the way they love me.
That's right.
So, but again, these are all these are all changes. And what's happening is you're seeing businesses jockey position to try and capture these tailwinds, like I said, whether it's the shift towards digital commerce, the shift towards mobile payments, the move with our clean living investment theme for cleaner, natural, more healthier ingredients, foods, and products that you're seeing Pepsi launch their own flavored seltzer business, or Coca-Cola not necessarily bring out a new soda vending machine, but have a Dasani free vending machine that takes water and can put sweeteners in it, natural sweeteners, and or seltzers, and that's where they make their money, to a whole host of other things. So it's a very fantastic and exciting world. Our lens, as you might imagine, Jay, is a little different than the formerly 11, now 12 sectors that S&P uses when it looks across the sea of companies. We have our 10 investing themes, and one of the questions you'll probably ask is does every company hit a theme? And the answer to that is no, it does not. Again, they have to be within the sweet spot of the theme to capture those benefits. So that's the way we look at it. And again, our lens is, a little different. But the great thing about it, Jay, is each and every week we publish thematic signals, which are signposts for our various investment themes, meaning just like Law and Order, you too, or your listeners too, can kind of rip data points from the headlines and see what's happening as it relates to these investment themes. And that's candidly one of the things I love, which is when we talk about these themes, whether it's aging of the population, the digital lifestyle, the rise of the new middle class, or even the middle class squeeze here in the U.S., digital infrastructure, which is the backbone for all these, for the increasing digital lifestyle that we have, all of these are rather recognizable and, more importantly, relatable, not just to other investors, but to everyday people. And I think your listeners will find that rather refreshing.
Yeah, I'd like to go deep on a couple of those themes, but first, let's talk about the changes that they made to the sector indexes and what the implications are for advisors who are allocating using sectors.
Sure. So if you remember, the S&P used to have 10 sectors, and then they added REITs, I think 18 months, 2 years ago, if my memory serves. So what you have in that is trying to shoehorn, again, thousands of companies into 11 sectors. And then early this year, they talked about starting to formulate another category. And they gave a lot of notification because there was going to be, some very high-profile names, particularly the FANG names, that were going to be pulled out of this, as well as some others, as they created a 12th sector known as communication services. So that rejiggering took place on September 24th, and we saw a number of different pieces kind of move around, everything from technology companies to consumer discretionary companies that were reclassified and folded into this new communication services group. Everything from AT&T to Alibaba to Apple to Netflix and the like. And if you think about those GICS classifications, they give rise to investing strategies that are followed by a number of different indices on which a number of different ETFs are based. So if you think of the domino effect, if you change or add the GICS criteria, it means you're going to have a ripple effect through that will alter the holdings of existing ETFs. So, advisors and subsequently their clients, kind of need to know, once again, hey, what does this change mean? How are these mappings happening? What am I really owning in this particular ETF? Because the windup could be, under the old mapping, a client might be going, oh, this is great. I have exposure to Apple because I have technology. May not be the case now. And it might cause some revisits to client portfolios. It also would likely make, at least in the short term, some trading volume a little, let's just say, wobbly as shares are moved around from one ETF to the other.
Well, let's timestamp this podcast then and talk about that. So we're recording this on October 5th at the end of the second week after that transition. The markets, they've been choppy. They've presented challenges. You have any thoughts as it relates to these changes?
That's a loaded question, right? Because I have yes is the answer. So if we think about it, there's been a number of factors that have been kind of weighing on the marketplace with some new, not new ones, but some ones that have been kind of lurking in the background of late. So what am I talking about here? Well, look, the second quarter hit GDP of around 4.2%, and the data that we got, for July, August kind of pointed to something softer than that. Okay, still growing. Don't misunderstand, still growing, but just not as vibrant as 4.2%. Along the way, you probably noticed a lot of headlines about trade and tariffs. And coming into September, we started to see that really start to pick up. In fact, both the U.S. and China escalated their tariffs against each other. And subsequently, though, we've seen an agreement between U.S., Mexico, and Canada, which many think, and I subscribe to, thinking that this could pave the way for a greater focus on a China trade resolution. But we'll see. Also along the way, we've had oil prices pick up, which consumers are starting to feel a little pinch at the pump. I think California is one of those markets where gas prices are starting to hit $4 a gallon. So one of the guys I'm on the radio with on a regular basis, Matt Ray, Out of America's First News confirmed that, yes, we are seeing that. So that has some concerns about maybe taking a bite out of disposable income at a time when the Fed looks poised to raise rates. If we think about the interest expense or the incremental interest expense out there on auto loans, credit card debt, and student debt, that could also be a headwind to consumer spending as we move into the seasonally strongest time of the year for that type of activity. And again, remember, it goes without saying that roughly 2/3, directly, indirectly, of the economy is driven by the consumer. And then just adding onto that pile of later two other factors, one is renewed concern about Italy and its proposed budget relative to the Eurozone, prompting such concern if it gets out of hand. Could Italy once again look to have its own currency and or stoke concerns that we had like a year ago of Italy, meaning Italy could potentially consider leaving the EU. And then as if that wasn't all enough, Jay, we've had a number of different companies that have reported results, Acuity, Nike, and the like, that have given, good quarterly results for the most recently trailing 3 months, but they've offered a number of reasons why their outlook is not matching the expectations. It could be everything from higher freight costs, higher input costs, uncertainty on trade, and some of the other things that we mentioned. So I sit there and I look at all of this and I say, expectations are for the S&P 500 group of companies to deliver 22% EPS growth in the back half of the year. Based on that assumption, we can understand why the market might be trading or had been trading around 18 times forward earnings for calendar year 2018. But the concern, and I've been writing about this, is we have these mounting number of issues, mounting number of headwinds, mounting number of concerns that could give rise to conservative guidance. And again, it looks like we're starting to see that. So as I look out over the next, 10 days, September quarter earnings season is really, really, really going to start to pick up. It's going to be fast. It's going to be furious. And the big risk I see is that expectations for the fourth quarter get lowered, and that really weighs on the market. So that's the big thing. And then riding alongside of that now, particularly given some of the data that we got earlier this week with the ADP employment report, with the wage growth that was reported in the September employment report, and the ISM services index for September, as well as the ISM manufacturing, all pointing towards inflation building up in the system. And then there was the comment by Fed Chair Powell earlier this week that there are several rate hikes to go until the Fed actually hits neutral territory, indicating that there will be several more rate hikes to come. And I think the concern, if you put those two together, is the Fed once again potentially behind the curve on inflation? And every data point that we get is going to be scrutinized over the next couple of weeks, looking to see, is inflation picking up? Is it hotter than expected? Is the Fed potentially behind the curve? And again, as we're taping this is October 5th. Next week, we have September PPI, September CPI, and we also have the NFIB Small Business Optimism Index, inside which they tend to talk about intention of capital spending plans, as well as some of the other issues that small businesses are facing. One of the big ones has been the ability of finding qualified talent. And again, the thought is employment rate, high 3 percentage points means at some point businesses will have to start bidding up wages in order to attract the talent that they need. Ergo, another component of potential inflation, and you can see how that all feeds together. So, a lot going on, but I would like to say that I was wrong. I didn't see this coming, but we've been writing about, again, our concerns, and unfortunately, it looks like some of them are coming through.
Hey, Chris, let's go a little bit deeper on inflation. Not only, I'd love your thoughts on what you think inflation is today, where you think it's going, and then thematically, how could advisors allocate their portfolios to either help capture returns in an inflationary environment or at the minimum protect on the downside?
Sure. So, is it 2.5%, 3%? I'm not sure what that number is. I would say that after years and years of waiting for inflation to arrive, guess what? We actually have it. And, a little bit of it is not a bad thing, but it looks like, the confluence of what we're seeing with oil prices and the impact that prices at the pump, what we're seeing with trade and tariffs is also contributing to higher costs, particularly on the commodity side. We are also seeing a shortage in available trucks and truck drivers, and that is also pushing up transportation costs. So when we look at that, plus the potential for wage gains, given the labor shortage that's out there, just again, given the commentary that we've heard over the last couple of months by the NFIB, it does look like inflation is, let's just say warming. I'm not going to call it out of hand, and hot at, 4%, but it's probably somewhere easily north of the Fed's, 2%, probably closer to, 3%, something like that. And that's candidly one of the interesting things when the Fed had their September FOMC meeting. If we looked out over their new economic projection forecast, they had inflation, 2%, 2.1% for this year, next year, and 2020, if my memory is correct. And even the comments that, that Powell gave during the press release kind of pointed to, inflation is where it is, not too worried about it. And again, then we get all this data. So I think that as we move into the end of the year and as gas prices remain elevated, remember in November, we could potentially slap some new tariffs on Iran. The truck shortage doesn't look like it's going to ameliorate anytime soon. So we'll have to watch those gas prices. There are reasons to think that inflation could pick up a little bit more, and that could force the Fed's hand. But we'll see. We're going to be very data dependent. In terms of your question on how do we use thematics to help insulate from this, Lenore Hawkins, Thematic's chief macro strategist, and a person who turns a phrase far better than I do, once said that Amazon is the inflation Death Star, which I think is very true. It allows people to price comparison shop far easier. You have to remember, too, that two-day delivery is now table stakes. And with Prime, you have yes, you pay the fee, but as we joked earlier, once you pass, you really start moving into free shipping territory, particularly if you're a frequent shopper unfortunately, like most of the people I know. That helps keeps prices down. I think we'll see other people start to do that as they try to shore up their market share position relative to Amazon. That could be Walmart and others. But again, we'll have to keep in mind some of the input costs that are out there for some of these items and what's being sold. But I would say that our digital lifestyle investing theme is probably one of the best ways to look at it and insulate yourself. The other is the middle class squeeze investing theme. This is where we take a look at a theme that has been created due to the fact that there have been so many people that have not seen wage gains, that they have taken on debt, whether it's student debt, auto debt, or simply credit card debt, that they need to trade down in their purchasing so that they can stretch their disposable income as far as they can. Now, one of the great poster children, for that theme is Costco. And I love Costco. I shop at Costco, and it's one of those areas that, you can really stretch your dollars. You're buying in bulk. And what's great about the company is that one of the key generators of its operating profit is not just the actual sales that we do, but it's the expanding footprint that they have through their membership, which is driven by new warehouses as well as repeat signups. Like, if you're like me, Jay, you probably got your Costco membership, and you sit there and you shop once and you're like, wow, this thing already paid for itself. Costco just reported last night they are seeing membership renewal rates north of 90%, which speaks to the power of their offering. They're going to open 20 new warehouses over the coming year, 3/4 of which will be in the U.S. Again, great for driving that high margin membership fee income. And they're going to open their first in Shanghai, China over the next year, which will be kind of interesting to see how that develops. So to me, that's kind of the yin and the yang. If you want to use technology in our digital lifestyle to hunt for lower prices, you can do that. If you want to actually go stretch your disposable income at something like a Costco, that middle class squeeze theme is another way to look at it.
So far we've talked about the digital lifestyle and the middle class squeeze as two of your themes. What is your favorite theme right now?
Oh my God, that's like asking me what's my favorite Springsteen song. I've seen him 50 times. That's a tough one. Well, so let me just think about for the listeners. So if you're sitting here like I am, and I'm just going to walk through the themes real quickly. If you're looking at the aging of the population, which ties to the demographic trend where the baby boomers are turning, more and more baby boomers are turning 70 every day. There are certain demands that they need, certain changes in their consumption patterns, how they shop, where they shop, how they live, where they might retire, that sort of thing, the amount of healthcare that they need, so on and so forth. That is a long-term theme. I don't think that there's any rush today, but be mindful of that. Clean living, this is an interesting one for us with more and more people shifting over towards, like I said earlier, clean ingredients, clean products, clean beverages, clean food, clean snacks. And we're seeing a lot of companies jockey for position. But the two that I would think of as we kind of move into the last 3 months of the year, three actually, I'll give you three. One would be guilty pleasures. Think alcohol, chocolate, coffee, all those little treats that we like, because we are going into the holidays, and whether it's going to be the $9 billion that is spent on Halloween, crazy if you think about it,
right?
Or Thanksgiving, or the holidays, and even carry a little further into Valentine's Day. Those are the types of things that could see a nice pickup. Also, too, given the environment that we're seeing in the marketplace, these guilty pleasures tend to be fairly inelastic in terms of demand. So, people might trade down, pain at the pump, whatever. I might not get an extra piece of pizza, but I'm still going to get my coffee. I'm still going to get my cigarettes. I'm still going to, get those little pieces of chocolate that make me feel good at night. So the guilty pleasure theme is one that I think will hold up. Digital lifestyle houses, like I said, the online commerce aspect of shopping or mobile shopping. So again, whether it's, Amazon or UPS that actually delivers those things, I think that theme has a very, very strong winds going into the end of the year. And also, too, if we look at another company that would be covered under that theme, Alibaba, which to me, we've seen the shares come under pressure of late, just given the simple fact that it's a proxy for the trade war with China. But the reality is, when you look under the hood, Alibaba is Amazon, several years ago, where it too has the retail-facing business, but it also has a cloud business. It has a growing entertainment business and some others. And as it continues to grow those non-retail services, as its user base grows, those non-retail businesses are shifting gears from being a drag on the operating profit line to eventually becoming a positive contributor, again, just like we saw with Amazon. And I wouldn't be surprised if longer term, the cloud business at Alibaba is a very, very powerful cash flow, very powerful operating profit generator. Again, just like it is at Amazon. So to me, put in a nutshell, Alibaba is Amazon a couple of years ago. And that was a great time to buy Amazon. And I think, once the trade war overhang removes, I think we'll see that be quickly realized by a number of players and investors. So, and then the last one was just middle class squeeze. How do these cash-strapped consumers, really extend their dollars over the next 3 months when they've got to spend on Halloween, Thanksgiving, and the like? And again, the great poster child there is going to be, there are several, but the greatest one to me is Costco. Probably because, and I don't know if you know this, but not only has Costco done a great job of increasing their food business, particularly their fresh food business, which is great because it brings repeat customers. It's probably one of the reasons that repeat traffic was up 4.9% in their recently completed quarter, and that's year over year. But did you know, Jay, that they are one of the largest sellers of beef not just in the United States, but in the world.
Who would have thought it?
Who would have thought it?
Who
And
would have
here's
thought
the thing. Well, me, only because I kind of knew that. But but all kidding aside. But one of the nice things about that is, I don't know, again, there's a lot of, confirming data points around for us. But one of the ones that I've been watching lately is beef prices, because they are an input for companies like Chipotle, like McDonald's, and others. And we are seeing real beef deflation come about, just given the size of the herd. And a new report is out talking about how beef prices will probably trend lower between now and 2020. So if you think of companies like the ones I just mentioned, or even Costco, that's a lot of interesting margin that can be made up.
Yeah. So, Chris, you're just a treasure trove of information. Current, timely. I assume that listeners could get this on a regular basis in your newsletters, and you have several. Could you walk us through what the investing report is, the pro report, and the Monday morning kickoff?
Sure. So there's the three that there are four things that we have, well, five things that we have out each and every week. So let me just walk you through. So Thematic Investing is the subscription newsletter. This is the one that we walk through a variety of data points. We use our thematic lens to ascertain which companies, investors should be owning now. Do we have some ETFs in there? We do have one or two ETFs in there. We have a select list that is, stocks we think that people should be owning because of their thematic position. But then we also have the thematic leaders list, which is which are the 11 companies that really comprise the 10 investing themes. You might say, Chris, you have 10 themes, you said 11. And I go, that's absolutely true, Jay. It's because to us, the thematic poster child that really cuts across the greatest number of our themes is Amazon. And we think that is just simply a core holding that people should be, literally holding on to. Mm-hmm. Whether it's the acceleration towards commerce, their international expansion, it's the cloud, it's their move into grocery with Whole Foods and some of the benefits that will be coming, it's the potential monetization of their Amazon Go technology that allows for cashierless retail, or the potential that is on its, the potential to be had as we find out more about its acquisition with PillPack, which gets it into the online pharmacy business, which to me is a no-brainer. And what I will tell you real quick, Jay, is if you look at all the things Amazon does, it is a master at removing friction from the transaction. And I think there's a lot more that they can do. So that's why it's one of the poster childs that we have out there for thematic investing. So that's Thematic Investing. We have Thematic Options Plus, which takes all that I just described, but we add a little more aggressive strategy using options. So that's a premium product, and I know subscribers love it. Particularly given those who are looking to, if you want to think about our aging the population, where some are undersaved for retirement, I know that there are those who like to dabble in the options market, and this is a way to use thematic investing to accomplish that. We also have the weekly wrap that Lenore Hawkins, and chief macro strategist that I mentioned earlier, writes a great deep dive on what's happening in the global macro economy, and we tie that back to thematics. We have the podcast, Cocktail Investing, which is free. You can find it on our website. You'll find it on iTunes and other places where you find podcasts. And that's, where we kind of do what you do, Jay, where we interview folks looking for insight and, great investing nuggets. And we also banter ourselves back and forth about some of the key things that we're observing in the marketplace, the economy, and other notables. And that really ties us up to our last, which is thematic signals. These are those signposts that I mentioned that are ripped from the daily lives, headlines, magazine articles, you name it, that are positive proof points for our different investing themes and our thematic lens. So that is another free thing that people can go to the website and sign up for. So we get a pretty healthy dose of paid products and free products.
I will have links to all of that in the show notes. If somebody wanted to type your URL into their browser now, how could they find you?
Yeah, it's Tematica, Tematica research.com. I'm on Twitter at Chris J. Versace. And I think, I'm on LinkedIn too, like everybody else. But the main ways of finding us would be at TematicaResearch.com and Chris J. Versace on Twitter.
Excellent. Hey, thanks so much for coming on the podcast, Chris.
Oh, happy to do it. Hopefully we can do it again.